Good morning, ladies and gentlemen. This is Clueless 8, and this is the pre-market AM report for September 29th, a day before the third quarter ends here in the U.S. financial markets. All right, so let me get straight to a couple of technicals, and we're going to go over a few things that I've been observing. Number one, volatility never left us, and it never will. That's just the way it is. At this point in time, the primary cause of the $800 billion or somewhere around there sell-off, global sell-off, the last round was propagated by a collapse at Glencore, one of the world's largest, well, the world's largest mining company. Some people call it the Goldman Sachs of the mining world. And when you have almost a 30% drop in the stock price, you're going to have ripple effect across the commodity arena, which is going to spill over into everything that trades in the market. That is exactly what we saw yesterday. I'm going to show you a couple of pictures on a couple of charts on the pattern on the charts, which clearly show that these were institutional margin call sell-offs. The selling was robotic, it was methodical, and it obviously hit everything along the way. A couple of things to keep in mind here. In this type of environment, and I've said this before and I'll say it again, in this type of environment, you have to have some hedges, period. Whether you have a small portfolio or a large portfolio, the bottom line is you've got to have a hedge. Because the way volatility runs is that at any given technical inflection point, the market can turn up and go higher to that next technical level, or come down towards, or break down towards the lower end of the technical levels. If you listen to my previous video cast that I put out there, which is a recording of a pretty intense advanced coaching session that I put up there to help other people listen, understand, because we covered quite a few things. I explained in clearest terms the risks to the market, the cause of those risks, and at the same time showed both the bullish and the bearish scenario on what might go on. That is exactly what played out. The UVXY, which is a terrific hedge, was called in as a trade at 48 or somewhere around there, $47, $48. I showed on my charts that it go towards 60. It went past that. It went to about 63. I also had another no, I think I just posted that in the chat room where I said, is it possible that it goes to 70? Or maybe I showed that on the chart. I can't remember. Right now, the UVX is trading down about $1.80 to 59.70. I sold a whole bunch of them in the low 60s. That was almost a 13 to 15 point gain. Okay. There's a small lot that's still running because you have to have hedges. SPY puts that were alerted yesterday at around $1 and change. I believe it was $1.60 around there. Were more than double. They went to about 370, if I'm correct. Okay, and so that's 120+% type of gain on those type of hedges. You have to have those in your portfolio, and it doesn't, because a unidirectional bet in this type of extreme volatile market where you get random structured, I call it structured volatility, because all this is planned and programmed into the machines. And by the machines, I mean the algo HFT machines, which run 90% of the trading in the market. So the bottom line is that between the hedges and starting to scale into the longs, which I have, we are seeing a 10-point move on the, as you can see here, this is a reversal candle. It's a 10-point move here, roughly, 9 and change on the E-minis. And I'm going to walk people through this so they understand a little bit what might go on. Keep in mind that we're humans. We do not control the machines. We can only adapt, be flexible, and try is the key word, to be one step ahead before they actually turn. Anybody who went heavy short at the close yesterday, right now, is going to be in a world of pain at the open. What happens after that, we'll see. So let me walk you through the charts here. This is a daily chart of the S&P 500 in the form of the E-minis, the futures, which are a great read because they give you a sort of a backstage view of what's happening. That's the simplest way I can put it. Okay. So looking at this here, you have the August 24th low. We all know that, and that's at 1830 on the E-minis. On the S&Ps, that should translate to about 18. What should translate? Translate to about 1820. The lows were 1821. So that should translate to, in my opinion, probably around like somewhere in the mid 1830s or so. So you have so you have those lows that we have to contend with. This is the Darvas box, gives you an idea what the wide trading range is from the breakdown back on the 19th of August, or I should say the 18th of August. And it's highly unlikely that over the short term that we're going to get up there. There's a lot of supply overhead. I mean, the overhead supply in the form of trapped longs who are going to be selling as the market tries to reclaim some of these levels. Keep in mind that the standard deviation between from the 50, this is the 50-day moving average, this is the 34-day moving average, okay, is at this point probably a standard deviation of almost -4. This was a standard deviation of almost -7. So what generally happens with markets, and you guys have seen this way too many times, is that you have mean reversion, and there's a technical, money management aspect behind it too, trading aspect behind it, where the mean reversion is going to basically act as a magnet. It does not mean that we're going to go back and test these levels immediately, but it does mean, and this thin line that you're looking at is the 5-day moving average right there. So you can be looking at around the E-minis about 1905 or so before we hit a roadblock. It still remains in a downtrend. So mean reversion means that we are going to basically try to close the gap, the distance between the 34-day moving average, the 50-day moving average, the downward sloping, I should say, and head towards there. So short term, I drew a couple of charts. There's a wide channel here. All right, and the upper end of the channel is around 1920. That's the best case scenario right now. There is also a smaller channel here, which is going to be showing up more on the 1-hour chart, as I'm going to show you, which shows that the upper end is somewhere around 1897, call it 1900. Let's take a look at the internals here. There's no doubt that the internals are deeply oversold and reached 3.46, which was similar. At least this one, the bottom end was 2.68. Let's call it 3. And this one during the big crash on that day was pretty much at the same level. Okay, was pretty much at the same level. So visually, you can just see that. So the bottom line is, an oversold condition does need to get alleviated, and a reset basically takes the markets higher. It does not mean it changes the overall trend down, but it's just a technical reset. If you look at the McClellan oscillator, on that day we reached a horrendous minus 338. Right now we are at minus 147. Now keep in mind that this low that we printed overnight, and I did mention that overnight we would basically go lower, and now has reversed in the early hours of the morning as Europe has reversed up, was pretty much the same level that we were at on the 25th of August. Now what does that all mean? It simply means that the market is finding support at some levels during that extremely turbulent time, which had caused the flash crash. I mean, during the flash crash and the 1,000-point drop in the market, well, 1,100-point drop in the Dow, to be honest. So those are the levels that I'm watching. Okay, this blue line here is the Bollinger Band. We are right now, as we speak, trying to enter through the Bollinger Band. This is the acceleration band. And let me move on to the 1-hour chart, which should give us a little bit more of a clearer idea. So here is the 1 hour chart. We have a, this is obviously, a bearish engulfing. That was the top. So we can use that as a measure. So draw a broad channel, pretty easy to understand. And then I drew a channel, these red lines here, which is the short-term downward sloping channel, right? That the market is trading in. So the upper end of this channel, as you can see, we're clearly inside the channel right now. The upper end of the channel is around 1900 on the E-minis. So translate that into 1904, maybe 1906 on the S&P 500. This particular pattern, let's look at this channel here. And look and notice that overnight we tested the bottom end of the channel. This chart was placed in front of members, Clueless 8 members, for them to see yesterday, and you can clearly see what happened. Now, one of the things that happened overnight was we were deeply oversold. We closed the day at here on Monday afternoon at 4, right there. Stochastics were deeply oversold on the 1 hour chart. This is a 1 hour chart. And guess where we are right now? We are getting overbought. It's funny, but the market in a way forces everyone to become a futures trader. Okay, and we will be introducing a futures trading course for people who are interested. And I'll tell you, most of the action is taking place overnight, and then a bunch of the action is taking place intraday. So you don't always have time to react, because right now futures are up 11 points and we are getting severely overbought. So what does it mean? In simple terms, and I'm a simple trader, okay? I'm not some complicated, hardcore rocket scientist, is all the calls that I bought all the way down on the S&Ps, I'm going to be selling them at the open. Okay? And then and sell not all of them. I'll probably sell 80% of them. I'm going to leave a little bit in there. Now on the 1 hour chart, there are some severe oversold conditions. This is your McClellan oscillator at minus 420, almost minus 418. That's a lot. Okay, so you will get a short-term bounce, and that's all we're waiting. That's all we need. This is all about tactical trading, not about long-term hope or opium. The market at some point probably turns. We'll see. There's a lot of risk factors out there globally that's hitting the markets. Companies like Goldman Sachs have they cut back on their S&P targets to 2,000 by the end of the year. That's fine. So at this point, let's take a closer look at this, and let me do this so I make it cleaner. Let's remove all the drawings. I got 2.5 minutes to finish this. Let me get my trusty drawing tool and show you. This is pattern symmetry. Okay. Right now we're getting to the top of the Darvas, right there, as we speak. Is this a bull flag? We don't know yet. Can it break down? It sure can. If we break down, we'll find support around 1864 on the E-minis. If that breaks, then we're looking lower. We're looking towards the August 24th lows. If we breaks up, then the next resistance will be right there at the 50-day moving average. This pattern, at one point or another, in my opinion, by this end of the week, in my opinion, I could be very wrong, but that's okay, we'll adapt as we go along. I think gets filled. That's not much. You're talking about a 40-point move from 1883. Yeah, roughly. Let me see, 17. Yeah, roughly about a 40-point move. Translates into about a 300-point rally from here. Given the ferocity of the selling that we've incurred, which is close to 900 points from just last week, or somewhere around there, getting back 300 to 600 points is not asking for the moon, right? So this pattern could get filled. If we completely break down, then there's no question about it that we're going to test the August 24th lows and probably go lower. So we'll have to keep an eye on that. So this is what we're seeing play out in front of us right now. I'll be posting some. I'll be posting the NYMO, the New York Stock Exchange McClellan oscillator. I'll be posting the 533 on the inside the end of the day report. Review them. When things happen that fast and you go outside the Bollinger, you generally tend to bounce back.